Hey, welcome to the Inner Sanctum with Sean Shallis. You know, today is game day, man. It's like Sunday, and Sunday for realtors and borrowers that are trying to buy a house. It's game day. You know, we're in the Inner Sanctum, and I just wanted to, I'm actually texting and calling, filling out some different loan applications and stuff like that, and figuring out what the best strategy is. Again, I'm going to say strategy, not just a rate. And you know, everybody talks about rates, and everybody talks about, hey, how do I get the best rate and the lowest fees, right? That's the number one question I always get. What's interesting is nobody ever talks about their strategy, both short-term, mid-term, and long-term. How to get the lowest rate, the lowest payment, with the least amount of investment in the property, but yet the highest rate of return and the least amount of risk. So we're going to talk about that in a second. Come on in, join me. I'm going to show you how to do it. All right, so the first thing is that most people that you're going to call are going to be either a mortgage broker or a mortgage banker or a loan officer. What is the difference between those three? So bankers and brokers are not the same. I work for a bank. I work for the fifth largest bank in the United States. We're actually a depository bank, and we actually loaning our own money. We're loaning the depositors money, or we can go to the Federal Reserve and borrow the money at the window from the Federal Reserve at zero cost. So when we're passing that money along to you, it's typically coming at the lowest possible cost with the lowest possible fees in the industry. If you go to a broker, the pure nature of the word broker means that they have to go borrow the money from somebody else. They're going to take your loan, package it up, and they're going to broker it out to different people and different organizations and different financial institutions, and also institutions that are borrowing money from people like us to then loan to your customer based on their situation and their scenario. Usually the people that are going to depository banks like us are people with really good credit. They don't have any issues and they can borrow money from anywhere. People that are going to brokers have a better chance, usually, if they have some banged up credit or something going on that is going to affect their situation long-term or short-term. And what's interesting is that in some cases, yes, a broker may be able to get you a better deal on a one-off. The likelihood is pretty slim, though, because if they have to borrow the money from somebody else and then give it to you, and the only way they get paid, bear in mind the word broker, if the only thing on their shelf is mortgages to sell, they have to get paid on the mortgage. And you are going to pay as the customer. The realtor is not going to pay. They got to get paid a commission, and that commission is going to get paid from you, and it's going to get paid as a fee for giving you the loan. With us, the bank is actually asking me to give you money because we're looking for depositors as much as we are people to give somebody a mortgage. So what's interesting is I don't consider myself a mortgage loan officer like in the generic sense. I consider myself more of a mortgage strategist. And what is the difference between the two? Well, first of all, I work for the fifth largest bank in the United States, which actually gives me the ability to offer you one of the largest product suites in the mortgage space, and also consumer loaning. Like, we do car loans, we do boats, we do RVs, we do all kinds of crazy things. And what's interesting, though, is we specialize in doing mortgages for people for 1 to 4 family homes. And here's where the catch comes. We're actually not really looking to give people loans. We're looking to help people to invest in their future. And we're looking for depositors more so than we are just somebody to give another loan to. You see, when the broker gets the loan and they do your loan, they're going to instantly take that loan and they're going to sell it off to somebody else like us. And we're going to service that loan for a period of time. Why not just go to the servicer, and why not just go directly to the source? So that's number one. Number two is, in addition to being the fifth largest bank in the United States, we can go to the Fed window and borrow the money directly from the federal government. Right, so if we can do that, that means inherently there's less of a cost for us and there's less of a cost for you that gets passed on to you. The next thing is in addition to our product suite, we also have some of the lowest fees in the industry, and we offer incentives if you're going to open a bank account with us. It's called relationship banking, and that can go anywhere from giving you up to a 0.25% and up to $1,000, a maximum of $1,000 on your loan amount for simply opening a bank account with us with $25 in an account. Or we can go as much as giving you almost 50, 60 basis points off the rate. So if your rate was 5.5, we can bring it down to 5 with you making a substantial deposit of money into one of our wealth or affluent bank accounts. So that's part one. And then part two is that it's not the company that gives you the loan. It's your individual loan officer and or broker or banker, like me. So what is the difference between me and the person you're going to call at a call center at, like, let's say, major loan brokers, companies like Rocket and Quicken and other companies like that are great companies, but they're brokers. And when they're giving the money out, they're actually charging you an additional fee to do it. The difference is, too, is when you're calling those people, you're usually talking to somebody in a call center that has very little interest in what's going to happen to you long term. They just want to get paid that moment in time and give you a rate. And what you're doing is doing what everybody else is. You're saying, hey, so give me the best possible rate with the least amount of fees and the least amount of cost, right? And that is normal to ask. The challenge is you're not asking the right question, which I would propose to you to say, are you looking for the lowest rate and the lowest fees, which usually comes at the highest cost, by the way? Or are you looking for a long-term strategy to where you put up as little as cash as possible, you leverage your money as high as possible to get the best rate of return on it when you invest in the real estate, and then also reduce your risk as much as possible and reduce the payment as much as possible in the short term, and then look forward in the long term to see how real estate is not buy it and forget it. Real estate is, it's a 30-year investment in some cases, or 15 years, depending on how long you do it. Most people, by the way, only live in their house for 6 to 8 years, and they get hung up on looking so far in advance that they forget about the immediate. So here's what I want to propose to you. As a mortgage strategist, and when I talk with you as a strategist and give you a mortgage strategy, what I want to actually do is, instead of just slinging you a loan and saying, here's the rate and here's what we can do, and here's what our fee is, which is what most people are going to compare, I want to actually get more of an understanding of what you're trying to accomplish. So in today's scenario, these two loans, it turns out that I had a conversation with somebody on Monday about a loan who I've been talking to for quite some time. They finally got to a place where they found the house. They got their offer accepted. They're excited. They're ready to go. And now what's happening is that now they're looking at rates and they're looking at fees and they're getting information from all over the place. And most of that information is coming from people that were their parents, their friends, their family, which everybody they trust. The challenge is those people haven't bought a house or been involved in the mortgage space for 30 years. And even if they have been in the side of a banking industry, they may not have seen what we're trying to accomplish or fully understand the strategy which we're presenting. So what the borrower is conditioned to believe that the more money I put down, the lower the interest rate and the better off I'm going to be. In most cases, yes. In most cases, the average person is trying to put down between 20% or more to avoid what's called PMI insurance, or private mortgage insurance. What's interesting is with our company, we're one of the few companies that if you're doing a jumbo loan, which by the way, the conventional loan limit is $766,550. Anything over that becomes a jumbo loan. So up to that point, it's a conventional loan. Up to $765.50 is a conventional loan. Anything above that, and by the way, a conventional loan is insured by the federal government. Anything above that becomes what they call a jumbo loan, which is not guaranteed by the government, but guaranteed by the financial institution giving you the mortgage. And it's usually referred to as a jumbo or portfolio loan. What's interesting is our particular company is one of the few companies that has a product where between $765.51 and $1 million on the loan amount, we'll actually do that loan with 10% down with no PMI insurance. So how does that look? Let me show you what that's going to look like now, and why when somebody texts me and says, hey, I'm buying a house for $895,000 and I want to know how much the rate is with 10% down and how much the rate is with 20% down. And I'm like, well, that really depends on which way we're going to structure it. And it also depends on what the fees are, because remember what I said, the lowest rate usually comes with the highest fees. So I'm going to show you two different scenarios. I'm going to show you why. So when I spoke to this borrower on Monday, I was explaining to them that they should lock the rate as soon as possible because on Wednesday, the jobs report is going to come out. Prior to that, everybody's aware of that, may or may not be aware of this. So the Fed's fund rate was actually reduced by 50 basis points last week. It was projected that it was going to be reduced by 25 basis points. So what's interesting is even though the Fed helped us out by giving us a huger reduction in the Fed's fund rate, what's interesting, the Fed does not determine mortgage rates. The Fed's only job is two things. They're to guard inflation and they're to reduce joblessness. Okay, there really is what their job is, their mandate is inflation and jobs. Okay, they're not in the mortgage business. What they are, though, they do govern the Fed's fund rate, which is typically runs parallel to the 10-year Treasury bond. And the 10-year Treasury bond does have a huge impact on rates and mortgages because most mortgage companies are going to use the 10-year Treasury as their base for a long-term interest rate. What's interesting is that when the Fed actually, everybody thought that, okay, we're going to reduce rates. So what the banks start doing is, even though they knew they were going to make a rate change in September on I believe it was the 19th, up in May and June, July, August, we were actually started to already make rate cuts and already reduce our mortgage rates because we were doing it in anticipation of what the Fed was going to do. The funny thing is most banks and most financial institutions and the economists assumed that we were only going to go 25 basis points. When we went 50 basis points, it actually set off a little bit of an alarm and a little bit of concern on, oh my God, what's going on? And what happened was instead of the mortgage rates coming down and instead of bonds becoming, the bond rate coming down, they actually went up. Interest rates on bonds went up. And what that does is it forces the rates on your mortgage to go up also. So after the Fed fund rate went down 50 basis points, the next day, the actual interest rate on a 30-year mortgage actually went up almost an eighth of a point to a quarter of a point, depending on who you talk to. So that was number one. Now that was prior, and I'm talking to both of these customers up until this point, and I said, listen, if you're going to do this, if you're going to find the house, lock it in and do this before the announcement. Well, Sean, they're going to announce going down. Just because they're announcing that they're going to go down doesn't mean that the mortgage rates are going to go down, as evidenced by exactly what I just said. The Fed fund rate went down 50 basis points. Interest rates on mortgages actually went up an eighth to a quarter of a point, depending on who you talk to the next day. So here's the next thing. Now it's Monday, it's Sunday, game day today. They find the house, they call me up, they say, hey, we're ready to go. We want to talk to you about interest rates and we want to talk about locking the loan. I said, okay, great, let's talk on Tuesday. We jump on a Zoom. I show them two different rates. I show them a mortgage for what they asked me for, which is 20% down, 30-year fixed rate mortgage, which is very conservative, which is great. And then I showed them a 7-1 ARM. It's an adjustable rate mortgage that's fixed for 7 years and adjusts after 7 years, one time every year after that. And I said to them point blank, I said, listen, this product is going to give you the lowest possible investment in the property because we can do it at 10% down, no PMI insurance, because if you take $895 and you take 10% off that, the loan amount ends up being $805. That means it's over the threshold, and it allows them to get a jumbo mortgage. It also allows me to give them a bigger discount on that product because it's a bank-owned product. The next thing it actually did was it actually enables us to give them a little bit of more rate spread. And the reason why is because in that particular product, we can actually go to a 7-year ARM, which is an adjustable rate mortgage, which means that inherently that rate will be anywhere between 3/8 to 0.5% less than the 30-year fixed rate, which means that they're putting in 10% versus 20%. They have no PMI insurance because that is our product between $760,000, $551,000, and $1 million. And now what they can do is actually take that extra 10%. And because they're a young family getting started out and they're going to have a baby, they want to have kids, they want to get some puppies, stuff like that, a cat, a dog. I said to them, I go, what if you just put 10% into the property and put the other 10% in a CD? Because right now CDs are, you can get a 12-month CD for 4%, 5%. Take the extra money, put it aside, reduce your payment, and take a short-term interest rate. Because every economist on the planet right now is telegraphing that we're going to reduce interest rates over the next 12 to 16 months. And even though in the short term rates went up a little bit, they're telegraphing that they're going to come down. And I said, but you want to lock the rate today on Tuesday. Well, why are you so adamant about that, Sean? We really want to think about it. And I said to him point blank, I said, what is there to think about? Getting a mortgage is a math equation. It's the acquisition price, the rate at which we give you, the cost of that rate, and what the monthly payment is. And they said, well, that's just what we're trying to figure out is what's the best way to do this. And I said, you go to a surgeon, you don't actually wake up halfway through the surgery and say, hey, you're not doing this correctly. You go to a surgeon for their professional opinion, you value their opinion. I consider myself a mortgage strategist. Why? I've been in the real estate industry for over 35 years. Since I got out of the Army, I was 17 years old. I went into the Army. I came out at 20. I'm now 58. That means I've been in the real estate industry for 38 years. And over that 38-year period, I've actually helped over 2,000 people buy, sell, or invest in a home as a realtor for about 25 years. And I actually helped them negotiate over $1 billion in mortgages and negotiate $1 billion in how to structure a deal and how to structure a long-term strategy for investing in real estate. And what's interesting is, as proof by my experience was 25 years. That meant that the people that I helped 25 years prior are now helping, I'm now helping their kids sell homes and their grandkids sell homes because what I told them in the beginning was accurate. And the strategy that we gave them lasted through, and it was accurate all the way through, so they came back to me and they asked for more. What's interesting on the mortgage side, what I'm learning after 3 years on the mortgage side, even though I coached and trained and worked with as a consultant to mortgage companies for probably 15 years, I only became a loan officer about 3 years ago. And what I quickly learned is people are only focused on rates, the rate and the fee. They're not focused on the bigger picture, which is what is the way that I can actually invest the least amount of my cash to get the lowest possible payment and the best terms and the best fees, and also get the best rate of return on my investment in the property long term with the least amount of stress and the least amount of exposure to the market, if you will, or risk. And I always talk about what is your tolerance for risk. And people are like, well, what's the big deal? I said, well, it is a big deal because if we can actually show you how to do a strategy where, I'll give you a perfect example of this. We're going to invest in one case, case A, we put down 10%, no PMI insurance, and we get a 7-1 arm. That payment is going to be for the principal and the interest on that property is $4,826. Okay, it's $4,826. If I put 20% down and I get a 30-year rate, which is actually higher, okay, the interest rate is higher, you're putting down an extra $89,500. That's a lot of money out of your bank account to save. This payment ends up being $4,408. I mean, you're really talking about $416 a month in the payment. So you put down 10%, you have no PMI insurance, you're going to pay, yes, you're going to pay about $418 more a month, but you're also getting a 4 to 5% return on the other $89,000 that's still in their bank account. And oh, by the way, here's the catch, and here's where it gets fun. If your bet is that interest rates are going to go down, not up over the next 16 to 24 months, the 7-year arm is the lowest rate. Okay, the payment is slightly higher, but you still have a wad of cash in the bank account. You only put up half as much cash. And here's what's the best part is, if I sell you a house for $1 million and it goes up 10%, how much is the rate of return? So if I put down on $1 million house, if I put down $100,000 and I make a $100,000 return, I made 100% of my money. If I put down $200,000 or 20%, which is conventional wisdom, I only made 50% of my money. Which one of the numbers is bigger and which one of them has less risk? And bear in mind, this strategy, again, mortgage strategy, is based on the fact that most likely rates will come down in the next 18 to 24 months. The bet is that you're either going to move out of that house in less than 7 years, or the rates are going to come down in the next 7 years to where you're going to refinance into a more conservative loan, and or you may even refinance to another adjustable rate just at a lower rate. It just depends on what the future cast of the market is. How do you know that the person that's giving you the strategy knows what they're talking about? 2 years ago, I called it. On Monday, I called it and told them, hey, you should lock the rate because when the jobs report comes out on Wednesday, there's a good chance rates are going to go up. Between the Tuesday conversation and Friday, rates went up 1/4 point. Why did they go up 1/4 point? Because the job rate came in high. Knowing that the person you're talking to is not some guy or some girl in a call center just slinging loans and trying to give you the best rate with the lowest fee, you want to know the bigger picture and say, hey, how does this affect me and my family? And how can I maximize the wad of cash that I'm going to use to invest in either real estate or into investable assets that are outside the real estate industry so that you can diversify your portfolio? So here's what the lesson learned is. If you just want to go get a loan with a rate and a fee, do yourself a favor, go online, Google, hey, best rates, best fees. If you want to actually invest your money wisely, that is spending money, in my opinion. You're spending money on a mortgage because you're just buying a rate and a fee. It's like walking into Costco and buying a TV, and really knowing nothing about a TV, and not knowing if that TV is going to last a year or for 3 years or 5 years, or why that particular TV is $1,000, but the one next to it is $2,500, and it's the same. It looks like they're the same, but they're really not. I would highly, highly advise you to talk to somebody like me who has 30 years of experience that's a real estate and mortgage strategist giving you a plan of success versus just a solution to your problem. I look forward to seeing you on the other side. Again, my name is Coach Sean Shallis, aka the Realty Coach, top producing loan officer of the fifth largest bank in the United States. Hopefully that explains why. And by the way, if you're not sure what I'm saying is accurate, look at our podcast. I mean, our podcast on $1 Billion Blind Spots is one, top producing loan officer is another one. And just Google my last name. I've been on more news channels and more media stations over the past 25 years than most people in the planet on the real estate industry. And what's interesting is you can talk to me, pick up my cell phone and call me like one-on-one, have a conversation with me. But yet, when you talk to me, I'm bringing you 30 years of experience and knowledge. Plus, I'm also bringing you an analysis of the market versus just looking at a little tiny segment of it. We're looking at the big picture. And we want to be your actual loan officer for your life. I want to be your mortgage guy. I don't want to just be some guy slinging you a loan in a call center. Get back to me. My name is Sean Shallis, top producing loan officer for the fifth largest bank, aka the Realty Coach. I'll look forward to seeing you on the other side. If you got questions or comments, please comment below. I can't wait for your comments, and I can't wait to help you figure out what is your strategy for success with your mortgage and your house acquisition. We'll see you on the other side, Coach Sean. By the way, it's game day, man. Have a great day.